Imagine you have $1,000 and put it all into Accenture. In 10 years, will it turn into 10,000 or flatline? Our study shows the max potential is just 3.4x. We're going straight to the 10K. To find out the problem, all right, let's break down Accenture. Looking ahead, 10 years into the future, to 2035. The big question, is it a good investment? First, let's set a benchmark. The S&P 500. You put in $1,000. After 10 years, you could get back over $3,100. That's a 3.1 times gain. Now, let's look at the QQQ, the tech index. Put in that same $1,000. It could become over $4,200, a 4.2 times return. So that's the competition. Now for Accenture, we are going to deep dive into the numbers. Behind the valuation, we used a few methods. First, we project its cash flow, just the raw cash it earns. Based on that, your $1,000 investment could grow to almost $3,900, a 3.9 times return, beating the S&P 500. Then, a second method. Looking at core earnings, this model is a bit more conservative. Your $1,000. It becomes about $3,200. So, a 3.2 times return. And the third method, based on dividends, the money they pay back to shareholders. With this one, your $1,000 could turn into roughly $3,400. That's a 3.4 times gain. So you have three different numbers. What's the takeaway? We average them out. For a final projection, and the result? Over the next decade, an investment of $1,000 in Accenture is projected to become nearly $3,500. That's a potential 3.5 times return, a very strong performance. One day, one stock. Today, we'll look into Accenture. Welcome to Stock Snack. All kind of financial numbers could be overwhelming. At Stock Snack, we help to analyze stock, if they are good or bad. At Stock Snack, we help justify it and present it to you fast and joy. Like having snack, subscribe now to find the simple truth in complex reports. Today, we will break things down into 4 parts. First, we had go through the price projection and had identified the current price listed in market is a bargain or not. Second, we'll go through the qualitative analysis. This is to gain some basic info of the company. For example, who are they? What are they selling? Who's their competitor, etc. Third, we will go through the business segment analysis. Identify what's their main business. Fourth, we will go through financial statement checklist to identify the financial health of the company. Want to skip ahead? The description has a timeline for easy navigation. You can also find the tools and resources I used to create this video there. So, who is Accenture? Let's get into the basics. The big picture. First, what do they actually do? Their business is simple. They help other businesses, helping them reinvent themselves. How? With technology and with consulting. That's the core mission. Now, the origin story, it's an interesting one. You see, it didn't start as Accenture. It was born inside another company, a famous accounting firm, Arthur Andersen. Accenture was just their consulting division way back in the day, and that leads to the timeline. Some key moments. It all started in 1989. The division gets its own name, Andersen Consulting. Then, a huge moment, January 2001. They split from the parent company. A new name is born, Accenture. And just a few months later, in July of that same year, they go public. Their IPO, a huge step. Fast forward to 2013. The world is changing. Everything is going digital. So they launch Accenture Digital, a massive focus on tech services. Then, 2019, they make a surprising move. They buy a creative agency, a famous one, Droga 5, pushing deep into advertising and marketing. And the most recent big news, June 2023. The next big frontier, artificial intelligence. They announced a huge investment, $3 billion into AI that tells you where they're headed. So, how big are they now? They're global, truly global, operating in over 200 cities, all around the world. And what do you call this industry? It's called professional services. But in simple terms, it's technology and consulting, and it's a B2B business. That means business to business. They don't sell to you or me. They sell their services to other companies. So where does their money come from? It's broken into 5 main groups. Number 1 is products. This is their biggest earner. They're helping companies that make things: consumer goods, retail, life sciences. Number 2 is health and public service. Think about government agencies and healthcare providers, hospitals, and insurance companies. Number 3, financial services. This is a classic. Working with banks, insurance companies, the big players on Wall Street. Number 4 is communications, media, and tech. Basically, the companies that connect us. Phone companies, media giants, and software platforms. And finally, number 5, resources. This means energy, utilities, chemical and natural resource companies, the industries that power the world. So there you have it, a quick look at who Accenture really is. Okay, let's talk about the competition, because every company has rivals. So who is Accenture really up against? We can look at this in 2 ways. First, let's look at the entire industry, the world of professional services. There's a group you've probably heard of. They call them the Big Four. The old accounting giants, plus Accenture. These 5 are the titans of the industry. At the very top of the list is Deloitte, huge in consulting and audit. Their revenue, almost $65 billion. Right behind them, number 2 is Accenture, with about $64 billion. So they're neck and neck, fighting for that top spot. Then you have PwC. They're big in audit and advisory, pulling in over $53 billion. Next, Ernst & Young, another powerhouse, bringing in almost $50 billion. And rounding out the top 5, KPMG, strong in audit, tax, and advisory services. Their revenue is over $36 billion. So that's the big league, the top of the mountain. But let's get more specific. Who are the competitors with a similar focus? The ones who are really in Accenture's lane, focusing on technology and consulting. The list changes slightly. It gets even more interesting. You still have the big guys: Deloitte, PwC, EY, KPMG. They're all competing for that same business. But there's another name we have to add, a true technology giant: IBM Consulting. You see, IBM is massive in AI and hybrid cloud, in business transformation. Their consulting division alone brings in around $35 billion, making them a huge competitor, fighting for the same clients as Accenture. So you have the traditional firms, and you have the pure tech players. It's a crowded field, and a tough fight. All right, we've looked at the numbers, the competitors. Now let's talk about the brand itself, the story, the qualitative stuff. First up, the management. The people running the show. What's the general feeling about them? Well, from the top down, they're seen as being very sharp, strategically focused. They have a clear vision. They know where they're going. But if you look from the inside out, from the employee perspective, the feedback gets a little more complex. You hear stories about work-life balance, about the struggle to climb the ladder. It seems experiences can vary a lot. So what is their main focus right now? Their business frontier. It's all about one word: reinvention, helping other companies completely transform, building what they call a strong digital core. And that core is powered by the biggest trends in tech: AI, data, the cloud, and of course, security. That's their battlefield. Okay, so what gives them an edge? What's their competitive advantage? It's really 2 things: their size and their reputation. They are a true global leader, a household name in the industry. When it comes to technology and consulting, they are one of the giants. They don't just follow innovation, they help drive it. Now, let's zoom out a bit. What's the trend for the entire industry? Everyone is moving in the same direction, pivoting to an AI-led future. It's no longer just about digital. It's about being intelligent, using AI to reinvent every single part of a business. That's where the whole industry is headed. So finally, what is Accenture's future direction? Their specific plan to win? It's simple. They want to lead with generative AI to be the #1 partner for any company looking to reinvent itself, helping their clients grow and helping them become more efficient. That is their North Star. Okay, let's follow the money. See where Accenture's revenue really comes from? We'll look at their business segments from 2019 to today and see what's changed. First up, their biggest segment, It's called products. Think retail, consumer goods. Back in 2019, it was doing about $12 billion. By 2025, it's projected to hit over $20 billion. That's fast growth. And its slice of the company pie. It's getting bigger. A clear winner. Next, we have health and public service. And this one is the star player, the fastest grower of all. It went from just over $7 billion to a projected $14.5 billion. It basically doubled, so its piece of the pie grew more than any other segment, a huge area of focus for them. Now for financial services, the banks, the insurance companies, it's still growing from about $8.5 billion to almost $12 billion, still beating inflation, still solid. But here's the interesting part. Its share of the company's total revenue is actually shrinking. Why? Because other parts are just growing so much faster. Then we have communications, media, and tech. And the story here is different. The growth has slowed down. It's not keeping pace. So its slice of the pie. It's getting smaller, losing ground to the faster-growing segments, and it's a similar story for resources. The energy and utility companies, it's growing, but slowly, and its share of the business is also shrinking. So that's the breakdown by industry. But there's another way to look at this. By the type of work they do, first is managed services. This is their long-term contract work, where they run entire operations for other companies. Back in 2019, it was about $19 billion. By 2025, it's projected to be over $33 billion. Huge, consistent growth. It's becoming their core business. The other half is consulting. The project-based work, it's still growing, from about $24 billion to $34 billion. But its share of the business is shrinking. Why? Because managed services is growing so much faster. Finally, let's slice it one more way. By geography, where in the world is the money coming from? The king is North America. It went from about $20 billion to a projected $33 billion. It's their biggest market, and its share of the business is growing. Almost half of everything they do. Number 2 is Europe, growing from almost $15 billion to over $23 billion, also growing fast, and its share is also getting bigger. But then you have the growth markets, and here the story is different. The growth is slow, from under $9 billion to just over $10 billion, so its slice of the pie is actually getting smaller. So what's the big picture here? The strategy is clear. They are shifting toward long-term, stable contracts with managed services, and they are doubling down on their strongest markets. North America and Europe, that's the engine of the company. Do you ever just drown in endless browser tabs, manually extracting data just to do a basic analysis on a stock? I used to, until I found this incredible site at stockanalysis.com. You can essentially do it all in one tab. It's fantastic. You can go from using their screener to find new ideas, to creating your own watch list, to checking the full trend of metrics in a company's annual reports. And the best part, the core platform is completely free. If you're ready to take the next step and seriously streamline your workflow, you can subscribe to their Pro package. This is where you unlock crucial features, like the ability to extract all that data into Excel. For custom modeling, the Pro plan is shockingly affordable. It works out to be less than $1 per day. That's institutional-grade data for the cost of pocket change. Feel free to drop a visit to the site. And if you decide to upgrade, make sure you subscribe with the code StockSnack to get a 10% discount. All right, let's get into the financial health check. The real numbers. This is where we see if the company is truly strong. Now, a quick overview of how we do this. We've gone through 3 main statements. From the annual reports, the balance sheet, the income statement, and the cash flow statement. For each one, we analyze multiple metrics to see if the company is healthy. We'll discuss the details later. But right now, we'll just provide an overview to get the top-line insights first before we deep dive. So, let's start with our quick rules of thumb check. Looking at the latest numbers. The balance sheet. It looks good, passing most of our tests. A very healthy score. The cash flow statement. Even better, really strong, passing with a 75% score. But the income statement. This one is mixed. Half good, half bad. So, A yellow flag there? Now, let's look at the 10-year history. Does the story change? The balance sheet is even stronger over the long run. Very consistent. But again, the income statement and the cash flow statement showing some inconsistencies over the past decade. So, let's simplify it even more. With 5 key attributes, a final checklist. 1. Is revenue growing faster than inflation? Yes, it is. That's a good score. 2. Are core earnings growing? Yes, they are. Another good score. 3. Is it generating strong free cash flow? Yes, definitely. A third good score. 4. Is its debt level safe and manageable? Absolutely. Very low debt. A fourth good score. So, things are looking great. But then, the last question, the big one, 5, is the stock priced well right now? Based on our projections, the answer is no. It looks a bit expensive. That is the only bad score on this list. So, the key highlight, Accenture is a financially healthy company. It's growing. It has low debt, but the current stock price might not be a bargain. The quality is high, but you might have to pay a premium for it. Okay, time to check the foundation, the balance sheet. This tells us if the company is built on solid rock or on sand. Let's look at the key highlights. First up, cash versus debt. This is a big one. It shows if a company can pay its bills. The benchmark here is simple. You want more cash than debt? So the number should be above 1. Accenture's latest number, it's 2.81. So for every dollar of debt, they have almost $3 in cash. That is very, very good. It means they are incredibly safe. They can pay off all their debts and still have plenty left over. A huge green flag. Next, let's look at debt to equity. This shows us how the company funds itself. Is it using its own money? Or is it relying on loans? The benchmark here is to be below 80%. Anything lower is safer. And Accenture, it's at 26%. That's fantastic. It shows they are self-financed. They're not leaning heavily on debt. Another big sign of financial strength. But it's not all perfect. Let's look at treasury stock. Now, this is a bit technical. It's basically a measure of share buybacks. The benchmark is simple. You want this number to be greater than 0. It shows the company is buying back its own stock, which is a sign of confidence, a way to return value to shareholders. But Accenture's number here is 0, according to our check. That's a point in the bad column. A small red flag, and one more mixed signal. Return on equity, or ROE. This shows how well they use shareholders' money to make a profit. Our benchmark is pretty high. We want to see it above 25%. And Accenture's latest number, it's right at 25%. So it just misses our mark. That's why it gets a bad score. But it's right on the edge. And you should know, their 10-year average is 30%, which is very good. So this is just something to watch. So, what's the bottom line? For the balance sheet, it is overwhelmingly strong. The good far outweighs the bad. The company is safe. It has tons of cash. Very little debt. A solid foundation. A few minor things to watch. But overall, a very healthy picture. All right, we've checked the balance sheet. It's solid. Now, let's look at the income statement. This is all about profitability. How much money do they actually make? Let's dive into the key highlights. First, a very important number, gross profit margin. This shows us if they have pricing power. The benchmark we use is high. We want to see it above 40%. That means for every dollar of sales, they keep 40 cents. But Accenture, their number is 32%. And it's been like that for years. So that's a bad score. Why? It tells us their business has thin margins. It's a higher revenue business, but not a high-profile margin one. Next, let's see how much they spend to get sales. We look at SG&A, selling general and admin costs. As a percentage of their gross profit, the benchmark here is to be low, under 30%. A low number means the product basically sells itself. Accenture's number, it's 51%. That is much higher than our benchmark. So it's another bad score. It confirms the story. This is a people business. It costs a lot of money in sales and overhead to win those big contracts. Now for some good news, debt. We look at interest expense compared to operating income. This shows how much of their earnings are eaten up by interest payments. The benchmark is to be very low, under 15%. And Accenture, their number is just 2%. That is fantastic. It's a good score. It proves what we saw on the balance sheet. They have very little debt, so interest payments are tiny. This makes the company much safer. But let's go back to profit. The bottom line, net profit margin. After all the bills are paid, what's left? For a company with a real competitive advantage, we want to see this above 20%. Accenture's number is 11%. So, another bad score. It's consistent with what we saw earlier, from the top line to the bottom line. The profit margins are just not that wide. So, what's the final picture? For the income statement, it's a story of trade-offs. The company is not risky. It has very low debt. That's the good part. But the bad part? The business itself has low profitability. They have to fight hard for every dollar of profit. It's a company built on scale and volume, not on high margins. Okay, last one, and maybe the most important. The cash flow statement. This is where the truth is. Because cash doesn't lie, let's look at the key highlights. First, something for the shareholders. Stock-based compensation. This is when a company pays employees with stock. It's common. But you don't want them to give away too much. Our benchmark is simple. Keep it under 10% of revenue. Anything more, and they're diluting your ownership. Accenture's number, just 3%. That's very low. It gets a good score. It shows they are responsible, and they respect their shareholders. But now for a big one. A potential red flag. Operating cash flow versus net income. Here's the benchmark. You always want your operating cash flow to be higher than your net income. It means your paper profits are turning into real cash in the bank. Accenture, their number is 0.6. That is a bad score. It means for every dollar of profit they report, they're only generating 67 cents of actual cash. This is a warning sign. It suggests the quality of their earnings might not be as high as you'd think. Now for some good news again. Let's talk about CAPEX, capital expenditures. How much money do they have to spend? Just to maintain the business, the benchmark is to be low, less than 25% of net income. It shows the business isn't capital intensive. And Accenture, their number is less than 8%. That is excellent. It's a good score. It tells us this is a capital-light business. They don't need to build expensive factories, which means more cash is left over for other things. So, what do they do with that leftover cash? They return it to shareholders through dividends and stock buybacks. But here's the benchmark. You still want them to have cash left over after those payments, so the total payout should be less than 100% of their free cash flow. Accenture's payout, about 64%. That is a good score. It means they can reward shareholders and still have plenty of cash left to reinvest in growing the business. That's exactly what you want to see. So, the final verdict on the cash flow statement, it's a mixed bag. They are shareholder friendly, and the business model is capital light. Those are the big positives. But the quality of their earnings is a concern. The profits, on paper, are not fully translating into cash in the bank. That's the big negative. So, what do you think? Comment your thought below. So, we've reached the end. After all the numbers and all the analysis, what's the final conclusion on Accenture? It is a very high-quality company, a true industry leader, financially strong, very safe. That's the good part. The bad part? Profit margins are thin, and the cash flow quality has some questions. But the biggest issue is the stock price. Our analysis shows it might be overvalued right now. A great business is not always a great investment at any price. Now, this doesn't mean good or bad for the stock. It's just an analysis. And different people have different opinions and different risk behavior. So that's our breakdown. Comment below to let us know what you want to deep dive for next.